Welcome to this session. We will look at the impact of Ramos' growth strategy of selling more of existing products and services in a new market on the business's financials. In an early session, we saw how Ramu analyzed the strategy using the first two C's of the 4C plus E framework. We will now take that analysis forward to see how the strategy impacts the financial elements of the business, such as revenue, costs, and capital requirements. As we saw earlier, Ramu had estimated the market size of the new market for tea and snacks. Next, he estimated his business's potential market share for tea and snacks. While analyzing the new market, Ramu realized that the customer profiles in both the proposed new location and the existing location are the same. This means that their preferences are also likely to be the same. Ramu knows that the buses that stop in front of his existing shop in the morning will also make a stop on their way back in the evening, which means that the buses that bring in customers in the morning will be the same buses that could provide customers for his new location in the evening. Similarly, the buses that stop in the evening at his existing shop can come back and provide customers in the new location in the next day morning. As Ramu knows the drivers of these buses, he is confident that he can persuade them to visit his new shop at the new location. He has even planned some free gift items for the drivers and their families as incentives to make them stop at his new shop. Ramu also analyzed the equipment, skills, and time required to be able to start and run a shop in the new location. He concluded that he needs to buy a new food truck and equipment for the truck. He also planned to hire 3 part-time workers to support him in both shops. He realized he will have to spend time to train the new workers. He also decided to divide his time carefully between the two shops. Hence, in the first month after opening the new shop, Ramu decided to spend the first half of the day at the proposed new location and the second half of the day at the existing location. Ramu is now ready to understand the impact of his growth strategy on the financials of the business. He is planning to increase revenue substantially. A safe assumption he is making is that the revenue from the existing shop will continue to remain same. He thinks if the existing shop manages to generate more revenue, achieving the forecast revenue will be easy. Let's examine the impact of Ramu's growth strategy on the direct costs of the business. The major component of direct costs that will be affected by the growth strategy is the cost of the raw materials. Running two shops will mean direct costs such as cost of transportation, electricity, fuel, and water will go up. As Ramu will be managing two shops, he may want to take a higher salary. Ramu is also planning to increase the salary of his co-worker in the existing shop. There will also be wages for the 3 new part-time workers and salary for 1 new full-time worker. Wages and salaries to the workers will go up significantly. There is likely to be a good increase in other costs. Additional costs will be incurred when a license is taken for the new shop and the license is renewed for the existing shop. Further, Ramu is planning to run a promotional scheme for the new shop in the first 2 months of operation. As a result, the other costs will go up. Ramu is not planning to take any loans. Hence, there will be no impact of interest payment on the indirect costs. However, with 2 food trucks operating, repair and maintenance costs may go up. Ramu will need to train his workers to take care of the assets well to manage the costs. Ramu now considers the impact of his growth strategy on fixed capital as well as working capital. Let's begin with the impact on fixed capital. Ramu needs to set up a new food truck with new equipment. A food truck is not available on rent. Hence, Ramu thinks about buying a truck using a bank loan. Then, he decides to use the retained earnings of the existing business to buy the truck. He is confident that the new shop will start doing well in a short span. Next, Ramu is aware that the cost of the equipment is not same as it was 2 years back when he started the first shop. The cost has gone up. Let's look at the impact on the working capital now. Even though fixed capital required is high, the burden on the working capital will not increase. This is because the majority of the business's revenue is in cash. However, fixed cost will go up from the first month itself. Ramu realizes that in the first 2 months of operation of the new shop, the revenue from both shops together will not be enough to cover all expenses. Hence, the working capital required in the first 2 months will be high. Knowing this, Ramu makes a couple of decisions for the 2-month period. One, he will continue to buy the same quantity of non-perishable items twice a week instead of once a week. He decides to increase the quantity he buys only when the revenue start increasing. Second, Ramu decides to take his salary from the account only on the 15th of the month instead of the beginning of the month. Ramu prepares a cash flow statement for every month. As you can see, the closing balance is much lower than the opening balance. Yes, the purchase of a food truck and other assets has resulted in a decrease of cash balance. However, the cash balance is a positive number. Ramu had made a conservative assumption that the new shop will generate only 30% of the expected revenue from the new market. This assumption indicates that variable costs will also be only 30%, which means the revenue from operations will meet the costs of the business. Hence, it can be said that Ramu will not be short of working capital in the first 2 months, even though the bank account balance will remain low. Ramu completes the analysis of the impact of the growth strategy on revenue, direct and indirect costs, and required capital. He is now ready to do the break-even analysis. Ramu makes a couple of assumptions. One, he assumes that the proportion of revenue that the business got last year from tea and snacks will continue to be the same in the coming year. 2. He assumes that the prices of tea and snacks will remain the same in the coming year. Based on these assumptions, he does the break-even calculations. Based on the performance of his existing shop, Ramu is confident that the business will be able to achieve the break-even volume. He plans to achieve the additional sales volume by focusing on those bus drivers he knows and who are likely to stop at his new shop. After doing the break-even analysis, Ramu can prepare the growth plan. We will discuss that step in the next session.